In the year 2000, AOL acquired Time Warner for $165 billion. It was supposed to redefine media. Instead, it became one of the most catastrophic mergers in corporate history. In 2015, Kraft merged with Heinz in a $46 billion deal backed by 3G Capital and Warren Buffett. Within a few years, billions in the market value were erased. And these aren't isolated examples. Study after study suggests that between 60 and 80% of mergers fail to create value for the shareholders. So here's the question. If mergers fail so often, why do smart CEOs keep doing them? When we say a merger fails, we don't necessarily mean the companies collapse. Failure usually means one of three things. First, the acquiring company overpays. Second, the expected synergies never materialize. Third, the combined company underperforms its industry peers. For example, if a company A buys company B for $50 billion, promising $5 billion in annual synergies, but 3 years later, earnings are flat and the stock is down 30%. Shareholders have effectively destroyed value. Even if the company survives, this is the uncomfortable truth of M&A. A deal can look strategically logical on paper, and it still fails financially. To understand why mergers keep happening, we need to look at incentives, because in M&A, incentives shape behavior. Number one, CEO compensation. Executive compensation is often tied to revenue growth, company size, and stock price performance. Acquisitions immediately increase revenue. They increase total assets. They increase perceived market dominance. A CEO who doubles company size through acquisitions can be rewarded even if long-term value creation is uncertain. This is sometimes called empire building. Growth itself becomes the objective. Number two, investment bank fees. Investment banks advise on deals and they earn fees based on the transaction size. A $20 billion acquisition can generate hundreds of millions in advisory fees. Whether the deal succeeds long-term is not directly tied to those fees. Banks are incentivized to close deals, not necessarily to ensure long-term integration success. Number three, board dynamics. Boards rely on management projections. Those projections include synergy estimates, growth assumptions, and cost savings. But these projections are inherently optimistic. No CEO presents a merger to the board saying, this might destroy shareholder value. The numbers are almost always framed in the best possible light. And once momentum builds around a deal, it becomes difficult to reverse course. At the center of almost every merger is one word, synergy. Synergies come in two forms. Cost synergies, reducing overlapping expenses, consolidating operations, eliminating redundancies. And revenue synergies, cross-selling products, expanding into new markets, increasing pricing power. Cost synergies are usually achievable. Layoffs and consolidations are measurable. Revenue synergies are far more uncertain. They rely on customer behavior, changing sales teams, coordinating perfectly, corporate cultures, aligning markets. And this is where many mergers collapse. Take AOL and Time Warner. The vision was digital distribution plus traditional media. But cultural clashes, technological shifts, and unrealistic assumptions turned synergy into fiction. When Daimler Chrysler, billed as a merger of equals, it struggled under conflicting management styles and brand positioning. The problem isn't that synergies don't exist, it's that they are frequently overestimated. Optimism is built into the spreadsheet. Beyond incentives and spreadsheets, there's something deeper at play: psychology. Large acquisitions are often framed as bold, transformative moves. They signal confidence, strength, and dominance. And in competitive industries, there's constant pressure. If we don't acquire them, our competitor will. This creates urgency. Deal momentum builds. And once public discussions begin, walking away can look like weakness. There's also overconfidence bias. CEOs who have led companies successfully may believe they can integrate better than others. They believe they can execute where others failed. But integration is not strategy. It's operational discipline over years. And that's where the real difficulty lies. Public companies operate under relentless growth expectations. Organic growth can be slow. Acquisitions are faster. Instead of building a new division over 5 years, you can buy one tomorrow. Investors reward growth. Markets reward expansion. In some cases, standing still feels riskier than making a bold move. So companies pursue acquisitions to maintain relevance, expand capabilities, or enter new markets quickly, even knowing the risks, because not acting also carries risk. Not all mergers fail. Some become defining strategic successes. Disney's acquisition of Pixar revitalized its animation business. Facebook's acquisition of Instagram strengthened its dominance in social media. Exxon and Mobil created one of the most powerful energy companies in history. What do successful deals tend to share? First, strategic clarity. The acquisition solves a clear problem. Second, disciplined pricing. They avoid extreme overpayment. Third, integration focus. Execution continues long after headlines fade. Successful acquirers treat integration as a multi-year process, not a press release victory. So why do 70% of the mergers fail? Not because executives are irrational, not because strategy is irrelevant, but because at billion-dollar scale, incentives distort decisions. Optimism inflates projections. Psychology accelerates commitment. And integration proves harder than expected. Mergers are not just financial transactions, they are human decisions, shaped by ambition, pressure, and risk. The next time you see a $40 billion acquisition announced, don't just ask, is this exciting? Ask, who benefits if it succeeds, and who still benefits if it fails? Because in mergers and acquisitions, those two answers are not always the same.